Good morning, you beautiful people. Today's Naked Shorts coming in from freaking Shark Baby because it's Shark Week every single week. You know what it is. What is up, everybody? Welcome to Trey's Trades, where we freaking talk fast and don't skip class, baby. I like to preface by saying that I'm not a financial advisor nor expert, so take what I say with a grain of salt. Let's get into the video. So I kind of want to touch on reverse repos and repos again because I put out a video here yesterday and the underlying message was great. Like the end state being the exact same. This is exactly what you want to see, right? But I think I can do a better job of explaining what's really happening here. So if you weren't able to check this out, it's the Feds are done with Hedgie games. I talked about reverse repos and why I think you're about to see a huge influx of cash getting moved around to a different spot. But I just wanted to take a couple minutes this morning to really walk everybody through this a little bit easier. So we're just going to walk through essentially what a repo is, what a reverse repo is, and how this affects the economy, the U.S. stock market, specifically shorted stocks, because I really do think this is going to play a factor in the overall AMC, GameStop, all these heavily shorted stocks, just based on what's been used with this capital. So without further ado, let's just get into this video. So a repo versus a reverse repo, right? What does this actually mean? So a repo and a reverse repo are both transactions that take place between the Federal Reserve, aka the Feds, and big banks or firms, right? So what happens here? Well, in a repo, it's very simple. You've got a buyer and you've got a seller, just as you would have in any sort of transaction. In a repo, the Feds are the buyers and the banks and firms are the sellers. And what are they transacting? So essentially, when this sort of thing happens, you've got a repo, the Feds have an end goal in mind, right? And typically in this sort of situation, it means the economy needs stimulated, right? So what would that mean? It would mean that banks and firms don't have a lot of money to help stimulate the economy. So if the Feds, for example, were to buy something, give cash to the banks or firms in, essentially transaction for treasury bills or securities, that can help stimulate the economy. So how does that happen, right? It actually lowers interest rates. And you can think about it very simply. You've got a higher amount of supply, you've got more money that can be lent, which gives you less overall demand, right? So higher demand is going to raise prices for things. Lower demand is going to lower prices for things. So typically if the Feds are giving out money to big banks and firms, what this is going to do is lower interest rates for mortgages, for loans. It can help stimulate the economy. It can just loosen things up, right? And when did this happen? Well, if you look back in March, for example, right, the economy wasn't doing very well. Everything shut down. Something was actually instated called the supplemental leveraging ratio, which gave big banks money from the Federal Reserve when all this stimulus was getting passed around, a lot of money was getting printed, right? And this set up the economy to sort of survive and weather the down days and the bad stuff that was happening, right? So this is a repo. The Feds are the buyers. They're giving money to the big banks and firms in exchange for treasury bills and or other securities. The banks and firms are the sellers, right? Now, at some point in time, the influx happens, right? It's called a repurchase agreement and then a reverse repurchase agreement because they are guaranteeing each other that at some point in time, they're going to transact that same thing back, right? The Feds are going to get back what they need. The banks are going to get back what they need, right? So in reverse repo, which is what we're going to be talking about here, as I mentioned in yesterday's video, the reverse repo market is extremely high right now. The overnight reverse repurchase agreements all the way up to, as of June 9th, what appears to be $502 billion. June 11th, you got $547 billion. And in yesterday's video, I talked about $720 billion getting agreed upon by the Federal Reserve on June 9th, which is going to be received within 15 days. This is going to come from big banks and firms. So in reverse repo, it flips. You've got the Feds who are actually the buyers and the banks who are, or actually, as I was, the Feds are the sellers and the banks are the buyers, right? So the Feds are selling treasury bills and securities to these banks in order to get their cash back. Now, in this sort of situation, what would be the reasoning for this? So, think back in March, the supplemental leveraging ratio comes out. They're trying to stimulate the economy. They're trying to get big banks enough money to essentially lend out extra cash, lower interest rates on loans, give more money to big institutions and investors who are trying to essentially stimulate the U.S. economy and the U.S. stock market. Of course, we all know what they did with that cash instead, aka shorting stocks and trying to bank on the economy crashing, right? Which is kind of ass backwards if you think about it, but nonetheless, that's what happened. And what happens essentially is the economy tightens, right? So you're taking money away from these big banks and firms, which is going to end up raising interest rates. Now, what's the reasoning for this? It's because when you decrease supply, demand goes up, right? So maybe your mortgage interest rate will go from, 2-3% up to 7, 8, 10, 11, 12. Who knows how high it'll go, right? Because lower money equals lower money to lend, which increases demand. And this works with more than just mortgage rates. This works with institutions and investors, right? Because we know that big institutions and investors are leveraging cash that they do not have. And this can easily come from these big banks and firms. So this is why the reverse repurchase agreement is very freaking, I think, important for what is actually happening here in the US stock market. So now that we have a basic understanding, right, a repo, the feds are the buyers, the banks are the sellers, the banks are selling these treasury bills and or securities, the feds are giving the banks money. Reverse repurchase agreement, right? That's the exact opposite thing. The feds are the ones that are selling and the banks are buying, right? So they're giving over cash to the feds in exchange for these treasury bills and securities, right? Feds are buying, banks give these treasury bills and securities, feds give the treasury bills and securities back, banks are buying, right? That's how this works. So now let's move into the meaning of this, right? How does this affect the economy and how does that affect the US stock market? So the economy, what this means is you're gonna have higher overall interest rates. This could be on loans, this could be on mortgages, this could be on a lot of different stuff. Anything that you can think of, essentially these big banks controlling lending of cash, massive amounts of liquidity, right? It decreases the availability for lending, which also directly ties into the stock market because as we know, shit, Adele. There's a lot of cash getting thrown around in the stock market that does not exist, right? It's leveraged money. Now, we're going to get into this here in a second, but this also increases inflation rates, right? So that's something I fully expect to happen. But how does this apply to AMC? How does this apply to a bunch of different heavily shorted stocks in the market, right? Those higher interest rates also apply to shares that are on loan, right? Because what happens here? What happens? If big banks are lending cash to big institutions like Citadel, BlackRock, Vanguard, Melvin Capital, whoever this may be, and all of a sudden they have to tighten down on how much actual free capital they've got, what this does is it decreases the overall supply, which means that if there's lending of capital, lending of cash taking place, essentially margin debt, by the way, it's very high right now, historic numbers at near $800 billion right now, 200 billion of that coming in the last 6 months, right? What happens is if a lot of that cash is getting put back into the Federal Reserve, that's going to raise interest rates on all of these margins, right? All the margins, all the cash that people are playing with that they don't actually have, interest rates go up. That puts pressure down on people because what ends up happening is you have less overall leverage. The banks are going to say, look, you can keep that leverage if you want, but we're going to double, triple, quadruple, whatever that actual interest rate is, right? I can't say the exact number, I don't know, but nonetheless, you get the point. This can lead to margin calls because it tightens down the overall economy, right? There's less cash going around, so you can't be as loose with your money. It tightens things up. And this actually basically winds down that supplemental leveraging ratio, which was instated back in February, March, in order to stimulate the economy, give banks extra capital, extra liquidity, so that they can essentially loan out money and get things moving, right? They're trying to stimulate the economy and make it so, everything doesn't just shut down and we go into another recession, right? Loosened economy is getting tightened up, which means that this reverse repurchase agreement is the tightening effect. So with that being said, right, touching back on the $720 billion, which is coming from this latest June 9th maturity distribution of securities, loans, and selected other assets and liabilities, right? What does this mean? Tightens down these banks. The banks have to get back money to the Fed, so if there's any sort of lending going on, whether it be with these treasury bills, maybe they're using this as collateral for different loans from different banks, maybe they're just using this to, it could be a variety of different things. The cash that the Federal Reserve gave them, they could have been lending out to other institutions, other firms, right? And you've seen this in the stock market, the influx of cash in the stock market, and frankly, how many stocks are being shorted right now is absurd. It's a huge, astronomical amount of shorting. AMC, GameStop, Cost, BlackBerry, Bed Bath & Beyond, Nokia, freaking Space, Virgin Galactic. There's so many different stocks out there that you can just watch and see what they've been trying to do with their cash. They're trying to use cash they do not have to bankrupt you, to bankrupt companies, and that tightens it down, right? Lower overall cash equals a lower supply, which make an increase in demand, right? Increase in demand raises interest rates. It raises interest rates and costs to borrow on loans, and higher interest rates means a higher lendee pressure. Now, what do I mean by that, right? This is how we're going to wrap up the video, but just to make it all run home, you've got big banks here, right, which have huge amounts of cash and have for quite some time because the Federal Reserve has given them a lot of freaking money. Now, what do they decide to do with this money, right? They're not just going to sit on it. That's not in their best interest, right? They want to make money with their money. So they lend it out, right? They lend it out to BlackRock, maybe. They lend it out to another bank. They lend it out to Citadel. I don't know why I put a C there. Citadel. They lend it out to people, right? That's essentially what ends up happening. So they need to get that money back if it's out on loan. And if they can't get it back, right, that hikes up interest rates. Like, let's just say, hypothetically speaking, they continue to lend money out. They don't recall this cash, right? What ends up happening instead is
higher interest rates, right? If they have the capital on hand to get back to the Federal Reserve, then so be it, right? That's they do they, we do we, right? But this is the end story, right? It doesn't take you can definitely put 2 and 2 together to get 4 here, right? Lower overall cash, just think of it like this. Lower overall cash supply equals higher interest rates for lending. And if people can't afford to pay interest rates, if they can't afford to keep up with the loans that they've got out, you know what happens next? It is freaking margin calls. So that's kind of the whole moral story behind what's happening here with the repos and the reverse repo market. It's insane. Just think of it like this. If I was to put this into some sort of analogy, let's say that you had, your mom who borrowed you $100, and in its place, you decided to give her, I don't know, your GameCube, right? That's your repurchase agreement. At some point in time, you're going to buy back that GameCube from your mom, right? You're going to give back that cash. She's going to give you back your GameCube. During that period of time, let's say that you decide to take that $100 and go super heavy in the stock market on a short stock, right? You decide that you want to go and bet against the U.S. economy because by her giving you that $100, she's trying to loosen you up, right? She's saying, look, like I understand things are tight right now. You do what you got to do. You go make that money. You do this what you want to help kind of stimulate your paycheck, to stimulate your bank account. And you decide to go take that and gamble. You decide to go take that and bet against yourself, the U.S. economy. You decide to go bet against all the little guys, right? It makes no sense. And that's what's happening in the U.S. economy right now. And I'm telling you, these guys are pissing on the electric fence. So, like I said, I wanted to just make some clarification points from my video yesterday talking about repurchase agreements. The underlying message is the same, but I definitely could have done a better job kind of walking through that whole process. And hopefully that gives you some good answers and you understand what's happening here now. But that's what I've got for this video. So blah, blah, blah. I know most people drop a like, consider subscribing. Whatever you want to do, my friends. Catch you on the next one. I'm going to tap my chest lightly. Much love and peace.